Welcome back to the Absolute Basics of Buy-to-Let webinar. This is part 2, presented by Roger Morris. So again, without any further ado, I'll hand you straight over to Roger.
Thank you, Natalie. So next we're going to look at the different components when constructing buy-to-let. The first one is the acronym ICR. What does it mean? How does it work? And how does it affect ultimately the amount of borrowing that a landlord can borrow when it comes to buying a property? And it works off what is the rental yield that the property will actually generate. So ICR is the interest cover ratio. The ICR measures the ability of a borrower to cover mortgage payments with their rental income. But it's so much more than that. Historically, an ICR was restricted or would be an average of 125%. So up until recent times, an ICR would have been at 125. But it had recently increased to an industry average when it comes to personal ownership of around 140%. And the reason that the ICR increased is because some of the factors that it will cover, apart from being able to make sure that the rental yield will at least cover the mortgage, it also is expected to cover the cost of a letting agent, which can be, say, 10%, the cost of the annual gas certificate, any basic repairs, rental voids. But in recent times, it also has to increase the increased tax burden on that particular buy-to-let. So a privately owned buy-to-let, where it's expected to be owned by a high or a top rate taxpayer, will have a bigger tax burden and a bigger consequence of an increase in tax. And that's why the ICR as an industry average moved from 125% to 140%. So if you want to look at how tax inefficient a particular product is, the higher the ICR, the more expected tax that buy-to-let property will contribute back to HMRC. Hence, limited company ICRs are still at 125. In other words, because they can offset the most allowable tax deductible expenses like interest payments and lender fees, therefore their tax burden is less, and therefore they have the lowest ICR, which is why ICRs themselves can denote whether or not the recommended choice is a choice that has the lowest amount of deductions and therefore potentially, and I say potentially, could generate the most net income after tax, is my simple explanation of what an ICR does. We then have EPCs, Energy Performance Certificates. These measure how effective a property is when it comes to the environment. And since October 2018, a buy-to-let property to be rented out on a long-term basis, not on a short-term basis, so this excludes currently holiday lets, needs to have an EPC rating of an E. LTV, which is equal to the same as in residential mortgages, is the loan to value. Typically, the maximum LTV is 75%, but in recent times, lenders like Moda Mortgages and CHL Mortgages have now increased lender yields to 80%, but that is subject to the ICR cover ratio, and the rental income will support an 80% LTV band, because if the income cover ratio in, say, a limited company basis of 125 and the rental yield does not support, potentially it can restrict the maximum LTV to, say, 75%, because the yield won't support the required rules to get it to 80%. And an SPV is a specific or special purpose vehicle. So limited companies used to be basically open. They could trade as they liked. But since the introduction of interest relief and the massive increase in demand for landlords to purchase in a limited companies, because obviously they'd want to expect and they'd want to exclude or be able to deduct the cost of finance, finance costs like interest and lender fees. Since April 2017, when forming a limited company, you had to create an SPV, a specific purpose vehicle, and these were denoted by SIC codes, standard industry classifications. So an SPV is a specific purpose vehicle that is restricted to certain activities as denoted by the SIC code, standard industry classification. And we'll come to that later on. And then we have an AST, an assured short hold tenancy. But with the introduction of the Renters' Rights Bill, this will be replaced to an APT, an assured periodic tenancy. And the rules and reasons change. An AST is normally a 6-month tenancy. An APT means the tenant has to give 2 months notice, but it's different for the landlord. And there's different rules depending on when the tenancy has started. So we then move to the types of tenancy. The first is a family assured tenancy, or what's called an AST. This ultimately will be replaced, and any ASTs will purely migrate to APTs, which is assured periodic tenancies. Ultimately, it builds in more protection for a tenant, that they will be able to stay in that property for a minimum period before an eviction process can start, but also give them more flexibility if the property is not suitable or they decide that they want to leave. But it's really all around the rules and regulations of why the regulations have changed when it comes to tenants and their legal rights. Then we got sharers on one short-term tenancy, or an AST. So when it comes to sharers on a short-term tenancy, that will be either an AST or an APT. It's about understanding how that works and how that's affected. There's a lot of lenders that will say 4 people on one tenancy is okay if they're not related, but that does denote also that it's a house of multiple occupation. And a house of multiple occupation is where there is 3 or more people sharing 1 or more facility, but that make up of more than 1 family. So often mortgage advisors can make the mistake because a lender is happy for, or say, let's just say 3 people are all on one AST, and the lender's happy that not to go on a HMO product. Therefore, the mortgage advisor think, well, it can't be a HMO then. It absolutely is. The definition of a HMO is where 3 or more people constituting a more than one family share 1 or more facility. Then you've got a corporate let. This is where that the tenancy has been given to a corporate entity. This doesn't just have to be a limited company of a business, it can also be the local authority. And then we have a common law tenancy, where the rental income exceeds more than £8,000 a month, immediately moves it from a standard AST to a common law tenancy. Then we've got a holiday let. Now, holiday let is a very generic expression of where a property is rented on a short-term basis, where all the utilities are included, and therefore either a daily, a weekly, or a contractual one-off, say, month basis. So you're renting a property for a month, includes all services. But it also covers Airbnb and particularly serviced accommodation. So serviced accommodation could be where a property is a holiday let and the property is rented on a service basis. So that means bed, linen, sheets, towels, everything's included. But these are now more commonly found in our industrial cities, Manchester, Liverpool, Birmingham, Rotherham. And it's where people are choosing to stay in serviced accommodation instead of a hotel when working away from home. So it's not a holiday, it's accommodation done on a short-term let basis. So holiday let actually covers working accommodation as much as holiday accommodation under that Serviced Accommodation Act. So what is income cover ratio? What does it mean? And Google will articulate this so well. It's about understanding the definition of interest cover or income cover ratio measures the ability of a borrower to cover their mortgage payments with their rental income. The calculation can sometimes involve stress testing, where a lender will calculate the ICR based on a higher mortgage rates to ensure a borrower can continue to cover mortgage payments such rates increased in the future. So there's a lot to do with background stress testing, portfolio stress testing, because of the regulations that came in 2017. Not only should a lender stress the purchase of the new property they're going to lend against, but the existing portfolio, even though that lender may not have any mortgages on those properties, there needs to make sure the portfolio will be sustainable to volatility within base rate, of which we have seen in recent years, where we saw a significant increase from average interest rates being on 5-year fixes at around 3% to average interest rates to around 6%. But this increased stress testing really did protect the buy-to-let market really well, and it helped them do what they needed to do. So when we come to income cover ratios, it covers the mortgage payment, increase in volatility to base rate, and thus increase to future increases in available fixed rates at the end of that particular 5-year when product transfers will become available. It covers off the cost of letting agency fees, standard maintenance, but also it needed to cover off the increased tax burden. So unfortunately, private ownership has less deductible expenses on average than a limited company. Limited companies have the ability to offset 100% of the lender fee. So you might have a mortgage payment of £1,000 a month, and you might have on some of the bigger mortgages quite sizable lender fees that could be in tens of thousands of pounds. These are all tax deductible before corporation tax is calculated. And this is significantly less negative to the outcome of a net income position, which is why ICRs can denote how favourable the overall tax structures of that particular product will offer. So owning a buy-to-let property in personal ownership or owning a buy-to-let in a limited company, what are the differences? When it comes to personal ownership, if you are a basic rate taxpayer, if your combined gross annual salary from earned employment and your net income except for the cost of finance added together, so that's your gross income from work and your net income from buy-to-let, but not deducting any finance costs. So in other words, just letting agency fees and repairs added together is, for example, less than 50,000, you are a basic rate taxpayer. This therefore means that the ICR calculation is at 125%. However, if you're a high rate or a top rate taxpayer, then your ICR calculation is something that you need to think about. And the reason it's higher is because you are no longer able to offset the cost of finance relief and therefore expected to make much bigger profits because you can't deduct the largest potential single expenditure when it comes to what HMRC will allow, and therefore the ICR is higher. When it comes to limited companies, the ICR is at 125 because a limited company can offset all deductible expenses at 100%. So if the mortgage payment was £1,000 a month, you can offset that at 100%. If the lender fee was £50,000, you can offset that at the end of, say, the 5-year fixed as a reduction in your corporation tax bill. And therefore, when looking at an ICR, lenders are more favourable on this type of ownership structure because of the way HMRC's rules work when it comes to the overall profitability, which therefore reduces the lender's risk, because more profitable the buy-to-let, the more likely the mortgage monthly interest payments will be met. So guys, it's easy to get confused, lost, puzzled or unsure. The recordings that Natalie and I will have done in part 1 and part 2 of this absolute basics will be available. And please don't think it's kind of a failure if you have to watch these a few times, because if it's the first time you've ever learned or began your journey when it comes to buy-to-let, it can seem complicated. It's not, it's just brand new. It's like, imagine me and Natalie were teaching you how to read and speak Japanese or Mandarin. It can be really complicated when first trying to read it and thinking, I'll never learn this, but you will. With our help and support, we'll be able to make sure that it won't take you long to be confident within the specialist world of buy-to-let. So let's give some real examples of what is ICR stress testing. Let's meet Susie. Susie is a personal ownership landlord and therefore a basic rate taxpayer. Susie has found a property she'd like to purchase for £200,000 at 75% LTV for a mortgage of £150,000 on a 2-year fixed rate product at 5% with a mortgage payment of £1,000. So the mortgage payment's £1,000. Susie's rental income was first surpassed the monthly cost, which it does at £1,300. We then need to stress test it at 125% because that is the ICR that the lender has given to a basic rate taxpayer like Susie. And the ICR means that there is a surplus in income. The next and important part is that Susie has passed the ICR, and all lenders will have a calculator on the website. There was 4.6 million approximate buy-to-lets in the UK. 55% of them have no debt, but of the 45% that do, the vast majority will hold them in personal names. And this becomes so important when, if you've got a couple, husband and wife, wanting to do a remortgage and the ICR doesn't fit, doing a blended ICR, particularly if they hold the property as tenants in common, can be the difference between being able to get a remortgage or not. Let's look at the following. If the wife, who is on £80,000 a year, and the husband, who doesn't work and is not using his tax allowance, own a buy-to-let in joint names, the ICR given as joint tenants will be a 140 ICR, which is the most tax inefficient ICR, and therefore the lender will give the lowest loan amount because they'll be paying the highest amount of tax. But if they moved to a blended ICR 50-50, the tax liability reduces, the ICR increases, as does the max loan as it becomes much more affordable. But imagine they move to 99 in 1 in favour of the husband who doesn't work, isn't using his tax allowance, the ICR moved to 25.15. So the lender is working out the fact that whether or not that mortgage and that structure of ownership and how tax efficient by the ICR. So if you have a scenario between a husband and wife where they own it as joint tenants and you knowingly know one is a high or a top rate taxpayer, one is a basic rate taxpayer, then tenants in common is something to think about. What we'll do is we will put together the understanding of that blended ICR, and there is lenders that will do this, which will look at it basically around the way that structure of ownership and how the income is derived. Of the buy-to-lets owned in personal names, a lot of them will still be held as joint tenants because originally, prior to the rules changing in 2017, they could have had a top rate taxpayer and a basic rate taxpayer, both would be allowed to offset the finance cost. But now, in the new rules, where one is a high rate taxpayer and can only offset just 20% of the interest payment, and the basic rate taxpayer in effect could offset it all, moving the tenants in common would be the most logical thing. Now, in tenants in common, by receiving tax advice, if the tax advice given in the scenario I've just explained, a tax advisor would say, yes, we're going to move the property from joint tenants to tenants in common. We're going to allow the husband to own 99% of the shares, therefore receive 99% of the income. So let's just give the rental income at £1,000 a month. On the left-hand side screen, the held as joint tenants, applicant one, the high rate taxpayer, would receive £500 a month and be taxed at 40% of that income. The basic rate taxpayer would have taken that £500 tax-free. If they moved to tenants in common, applicant one would only receive 1% of the income, taxed at 40%, but applicant two would get £999 tax-free. So you can immediately see why moving to tenants in common is great. The only thing you've got to watch is if there was a mortgage of £250,000 and applicant one was therefore going to transfer over their mortgage liability because the percentage of debt would move 99% in favour of applicant two, as long as the transferable debt is less than £125,000, no stamp duty is payable. But above £125,000, then basic rate stamp duty would be given on that consideration. But it's done at basic rate, not at the high rate, even though it's a buy-to-let, can get confusing. But HMRC and a tax advisor can explain this. What would need to happen is after receiving tax advice, which your tax advisor will give, you would need to create a trust document. This would need to go as a Schedule A notification on land reg. This would need to be done by a solicitor only when that legal document has been signed and they've legally defined that the property is now held on unequal shares, and that is lodged with lodged with land reg as a Schedule A notification. Then the applicants themselves would need to go onto HMRC's website and fill out Form 17, which is now an electronic form. They will not benefit from taking the income on an unequal basis. In other words, 99% in being taken by the husband, the basic rate taxpayer, till this form is filled out. So it's an electronic form. Once filled out, it needs to be sent back with a copy of the trust document to HMRC, and this needs to be done as quickly as possible. It says 60 days, but the revenue are behind at the moment, or given respect to the revenue, get this form to them as quickly as possible. HMRC provides some incredibly supportive online training and information. Remember there to ensure the law of the land is upheld, and any questions to do with anything you're unsure about, HMRC are always there to help and give good, solid advice, and their staff are very well trained, but they cannot give tax advice. That needs to be done by a tax advisor. So what is a portfolio landlord? Now, a portfolio landlord, as defined by mortgage lenders, not by common sense. Let me explain that. A portfolio landlord is a landlord typically defined as a landlord who owns 4 or more mortgage buy-to-let properties. So as a layperson, if a landlord has got 30 properties, we call them a portfolio landlord. But for lending purposes, if those properties have no debt, they're irrelevant. There's no inherent risk because there's no funding against it. In other words, they've got very little expenditure apart from, say, maintenance and letting agency fees. So lenders are only interested in mortgage buy-to-lets. So if the landlord has got 3 mortgage buy-to-lets and is purchasing a 4th with a mortgage, they'd be classed as a portfolio landlord. So it's at the end of the transaction what they would be. So what's background stress testing? It's very important when a lender is looking to fund a new purchase that their existing portfolio in the background is sustainable to increase in interest rates, as would be the new property. So let's give you a good example of this and what it actually means. Background stress testing takes into account the borrower's combined portfolio when calculating whether they can cover the mortgage payments should interest rates increase in the future. Let's meet David. David's a portfolio landlord with 4 mortgage properties currently in his portfolio. David has found a 5th property he'd like to purchase for £200,000, 75% loan to value, 150 grand mortgage, 2 years, fixed rate mortgage 5% and a monthly payment of £1,000. The combined portfolio mortgage payments is 7,000. David's combined rental income must surpass the combined mortgage payments he's paying for his 4 current buy-let properties, and the combined income is 10%. So we now need to stress test this at an industry average of 140%. Does it pass? Yes, it does. And what that means is an average industry pass, then we're able to say that David's portfolio meets the required rules. Forming a limited company is like learning to drive. I think the primary reason that the acceleration of purchasing properties in limited companies in recent times has been lack of confidence in the industry from mortgage advisors speaking to landlords. If a landlord says, Rog, why a limited company and how complicated it is to set up? And I think it's because mortgage advisors have never gone on to Companies House and looked at the very simple 6-minute tutorials of how to form a limited company. The most complicated question I've ever been asked in all the limited companies I've helped friends, advisors, other landlords set up, the most complicated question I think you will ever get asked is this: what do I call the company, Rog? That is as complicated as it gets, because setting up a limited company is absolutely so easy. You've got to think of a name that's professional and a name that reflects well. Don't come up with a silly name, because you are trying to obtain money from lenders and you need to look professional. So this is what Companies House is given when it comes to the online process. First, you're forming a specific purpose vehicle. A specific purpose vehicle, SPV, is this distinct legal entity created specifically to acquire and manage property assets, offering potential tax efficiencies and simplified mortgage arrangements. Here are the 10 key steps and consideration when establishing an SPV as a limited company for buy-to-let property investment. Determine the suitability of the SPV. Before proceeding, assess whether an SPV aligns with your investment objectives. Basically, speak to a tax advisor. Potential benefits: reduce personal liability, offset mortgage interest against rental income, low corporation tax rates compared to personal tax rates, succession planning, and high HT. Potential implications: additional administration, additional costs, dividend or other profit extractions may incur additional tax liabilities. And independent legal advice requirements. So when taking out a mortgage and you're giving a personal guarantee for the limited company, you need to get independent legal advice that you understand what it is that you're doing. But you should always get good tax advice just to make sure you understand the two differences. Choose a company name. Guys, if you are worried about engaging with a landlord and they've had tax advice and they want to set up a limited company, it's really fun. The only bit that you really want to get nailed is what is the name you want. And when you think you've come up with a name, like for instance, I Love Roger Limited, go on to Companies House, check it out, is it available, and then decide if you want it. 2 key points: I wouldn't use I Love Roger because it's not very professional. But secondly, before you register that limited company name, see if the email domain name is available, because the moment you register a limited company, there's people that will go and register that domain name, so you then end up having to buy it. I just remember when I formed my first limited company, I wish I got the email domain name if I knew the name was available. Next is appoint the directors and shareholders. So since April 2017, we used to have a director and a shareholder or a company secretary. Now, one person can be the director and the same shareholder. In other words, Roger Morris can be the only person who has one share, and I can cover all those requirements. And if you want to know what the rules and responsibility, just follow the QR code. Next is prepare the necessary documentation, so memorandums of associations and articles of association. Very easy to understand, and the template format's there, or your accountant can set this up and do it all for you. And a lot of you might be thinking, Rog, I think we'll just do that. But it is so easy. Register with Company House, submit the incorporation documents. And once you've done that, the most important thing is to provide registered office address and specify the business activity. All UK buy-to-let lenders on forming an SPV for the purpose of buy-to-let will want all or one, two or three of these standard industry classification codings: 68100, 68209 and 68320. These are the three I would have on my SPV. Only these three. I wouldn't just have one or two of them. I'd have all these three, and then you're good to go. After we've done that, we then register for taxes, which is pretty straightforward. And then we open a business bank account. Now, guys, you can form a limited company with your SPV in about 6 minutes. Opening a business bank account with one of the big four on the high street can take weeks. So it might be better to use one of the online bank accounts, which you can do in a matter of minutes. And therefore, you literally could submit an application to a lender, all done and dusted in under an hour, which means if you've got to urgently get a valuation done and an application moving, that might make sense. We have maintained statutory records, and these can easily be found by going on to Company's House, and it's about understanding your requirements and making sure that you do your annual tax returns. Having a chartered accountant do these for you will be a requirement. For secure financing is straightforward. It's about understanding what lenders will do it and how it works. And it really does mean the importance of having those three specific SIC codes for you to secure finance with all the buy-to-let lenders. Lenders like CHL will do trading businesses. We're much more relaxed, but that's because buy-to-let's in our DNA. So we then understand really how everything works, including IHT planning. And it's the importance of how succession transferring of portfolios can really work. So setting up a limited company is straightforward and done under Company's House rules. Next, I want to cover off top slicing. What is top slicing? It's interest cover ratio, and it's about understanding how rental income works. You've got a scenario here where there's an affordability shortfall. The rental income just doesn't meet the lender's ICR requirements. What can we do, particularly if the applicant has got surplus income? In other words, they've got a really good job, they don't have lots of outgoings, and they would like to use surplus income to cover that shortfall. So meet Jack. Jack, a personal ownership landlord looking to purchase a new property to add to his existing portfolio of 2 buy-to-lets. He's a barrister and he's a high-rate taxpayer. Alternatively, coming to Moda Mortgages using top slicing, he needs it to cover 100% of the unstressed mortgage rate, of which he meets. So let's have a look at Jack's situation. Let's just say Jack is looking to take out a 75% loan to value mortgage fixed at 3.59 for 2 years. The stress test rate is 5.59 with an average 140 ICR. Jack needs monthly income of 1,750 to satisfy, but it's only giving 1,400. So Jack's got a shortfall of £350. Whilst the 140 rental income doesn't cover the standard 140 ICR, it does covers the ICR of 110 when stressed at 3.59 pay rate. So Jack qualifies for top slicing. After evidencing Jack's income and expenditure, we can see he has around £650 of earned surplus income. Adding this 650 disposable income to the rental of 1,400 gives an income total of £2,050, satisfying the 140 needed for the original ICR, meaning Jack can now proceed. Lenders will use the standard income as you would for a residential application. Nothing on this is out of what you would normally have. However, we do need to make sure we stress test credit cards at 5%, overdrafts, unsecured loan payments, car finance payments, but particularly the residential mortgage is stressed at an extra 3%. What I would say, because of ONS data, Office of National Statistics, I don't think top slicing will work for anybody less than £100,000 as my rule of thumb, because the ONS data will ensure that they have a minimum amount of their earned income covers their standard expenditure. And I wouldn't expect this to work at all for someone on £40,000 or £50,000 a year. It's normally 100,000 or more, and it's more for those people in quite high-earned jobs. The last part I really want to cover now is day one remortgage. A day one remortgage was a term used in 2007, where on a morning at 9 o'clock you'd purchase a property on a bridge, and at midday you'd refinance it on a term 35-year buy-to-let mortgage. Lenders at that point, because of the systemic fraud, moved away from anybody refinancing a property that they hadn't owned for 6 months. But lenders now, with their sophisticated checks, are very happy landlords who purchase a property and in a matter of days or weeks improve the value of the property by some simple measures. It could be just the property was dirty and it was full of rubbish and it was painting and decorating, landscaping the garden, or more substantial repairs. So here's an example. A property was purchased for £250,000. The landlord purchased it on bridging finance at 75%, and the landlord wanted to undertake immediate works to improve the kitchen, central heating, painting and decorating, carpets, double glazing and new bathroom. And by spending £35,000 on a property in a matter of weeks, it increased its value by £60,000. And the landlord wanted to be able to increase and refinance this to 75%. But now you can even do it to 80% subject to the ICR working. What this means is the landlord in a matter of weeks is able to extract that equity increase, and the lender is able to then finance a much higher quality property than that had previously. And all this becomes within the 6-month period. And the last point to really talk about is the Renters' Rights Bill. And the Renters' Rights Bill itself has gone through Parliament now and has changed the whole rental landscape forever. The other last point to really cover off, and we will, by the way, do the Renters' Rights Bill in more detail on another webinar, giving you the practical and useful information. The last point to cover off, if you would like to take a qualification which talks specifically on one of the components is on buy-to-let, is to check out the Level 3 Certified Practitioners in Special Property Finance, CPSP, which has 3 components: a commercial section, a bridging section, and the buy-to-let section. I was lucky enough to have been invited to write the course study material and the exam questions for the buy-to-let section, of which we're going to extract from of the basic foundation modules for understanding the level of studying needed for that buy-to-let point. So hopefully on that particular point, you've enjoyed. There isn't, because this is a recorded presentation, to ask any questions, but I just want to say thank you for listening in, and hopefully we'll catch up at some point face to face. Back to you, Natalie.
Wow, Roger, I think you've given us lots of information there. So as Roger said, we hope you've taken a lot from it. But join us for the remaining webinars that we'll be presenting in this series. But thanks for watching, and we hope to see you all soon.